Hello, Marc from ADM Investor Services International. This week's thoughts are, to a certain extent, an extension of last week's. What I want to focus on is yield curves and commodity prices, and particularly how this current move looks in the context of previous up moves that we've seen in yields. So my first chart is the US 2-year versus the US 30-year yield. And as one can see, the 2-year yield really has barely budged. In fact, it's close to its lows, while the 30-year yield has risen very sharply. Now, interestingly, this almost has the sort of look of the taper tantrum back in 2013 as an up move, but obviously with one key difference, namely that the 2-year yields are not moving in sympathy with that. So it's clearly a curve adjustment. What it's down to a certain extent, it's expectations of economic recovery. Certainly, certain parts it's to do with commodity prices and expected rise in inflation, and thirdly, above all, related to the increase in fiscal deficits, particularly in the US in this particular case. However, when one looks at my second chart, which is the US Treasury Volatility Index, what distinguishes the current move from, say, the move in February, March, April last year is we're not really seeing any great volatility in US Treasury prices. It's a far more attritional up move in long-term yields. And per se, not a particularly great threat, particularly as the Fed will be looking at it and saying, well, this is primarily an upward adjustment in nominal yields, and real US Treasury yields are being kept low because of the Fed's commitment to keep rates lower for longer. So how does this play out elsewhere? Because there are obviously moves in other G7 bond markets which are very much in sympathy. So the first one we'll look at is Germany. German 2-year yields, where basically, and I think this is the important point also about the Treasury chart, is in the US, we are actually above pre-COVID-19 levels or pandemic crisis levels in US 30 yields. In Germany, we're getting very, very close. Interestingly, I think in the fourth chart today, what one can see is Japanese 30-year yields are not only above where they were at the start of 2020, they're almost above levels where they were at the start of 2019. So this is a marked upward shift. And even here, there's been a somewhat more of an upward adjustment in yields in the 2-year area, primarily a recognition that the Bank of Japan is unlikely to do much with rates in either direction. There had been some talk of them cutting rates further into negative territory, but they're clearly not doing that. Now, if this is anything to do with commodity prices, and there is plenty of speculation that we are going into a commodity price super cycle now, perhaps we should have a look at commodity prices. So I pulled up the Bloomberg Commodity Price Index. I prefer this to many of the others simply because it doesn't have the chronic overweighting of oil and gold within it. And really, if one's talking about a commodity price super cycle, we are barely at the foothills. In fact, we are only nearing the foothills if this is going to be a climb up a very sharp curve. It's nothing like the 70s move, and it's certainly nothing like the move that we saw in the noughties, i.e. the 2000-2010 era associated with Japan. What worries me about this is when I look at overall managed money, i.e. speculative positions in commodities, we are now at 2.76 million contracts. That's a record long. It's above the peaks from 2014 and 2017, which were both about 2.45 million. So there's a lot of speculative money driving these commodity prices higher. What worries me rather more materially is my final chart, which is the UN FAO OECD Food Price Index, which, as one can see, is starting to rise very, very sharply. And this could create a lot of problems if we're going to start to see problems with food prices for people basically where unemployment levels are starting to rise and indeed wages are not. So those are the thoughts for this week.